Welcome to another episode of the Riffle, a podcast series brought to you by 10 Leaves.
Yeah, glad to be here.
You know, when you walk into a really highly regulated high-end restaurant, you usually expect a very rigid set menu.
Right.
You get the appetizer, the main, the dessert, purely as the chef designed it. And I mean, if you ask the waiter to mix the appetizer with the dessert, they kind of look at you like you've lost your mind.
Yeah, you don't do that.
No. The rules are the rules.
Yeah.
It's safe, it's predictable, and it's, heavily controlled.
Well, the boundaries in that kind of environment are strictly drawn for a reason, right?
Exactly.
The establishment knows how to prepare the dish without any surprises. Risk is mitigated through really aggressive categorization. It's a system built entirely on classification.
But imagine you walk into that same restaurant today, and the waiter just hands you a plate, points to a massive open concept kitchen, basically says, go ahead, build whatever you want.
Wow.
Right? They're just like, we're just going to make sure the kitchen itself doesn't catch on fire.
That's quite the shift.
It is. And that shift in philosophy is what brings us to today's topic. We are taking a custom-tailored deep dive into a massive, highly anticipated stack of regulatory source material that dropped literally today, July 7th, 2026.
Hot off the presses.
Literally. The Dubai Financial Services Authority, the DFSA, has just released Consultation Paper No. 173.
And, to call this a simple regulatory update would be a massive disservice to the scale of the document.
Yeah.
This is the first comprehensive overhaul of their collective investment fund framework since, 2010?
2010, yeah.
So we are looking at a fundamental rewiring of how funds operate and scale within the DIFC.
And for you listening, whether you are an institutional allocator, a fund manager on the ground, or, just someone who's insanely curious about the mechanics of global capital flows, this matters deeply. This 20-page document is the blueprint for the future of finance in the Middle East. It dictates how capital moves, how leverage is monitored, and who actually gets to manage it. Okay, let's unpack this. What is the core philosophy driving this overhaul?
So the overarching theme here is a massive shift away from rigid prescriptive rules. They're moving toward a highly fluid, risk-based approach.
Okay.
The DFSA is looking at the global landscape and recognizing that the old method, putting every fund into a neat, specific little box, it's just obsolete.
Right, because funds are so much more complex now.
Exactly. It just doesn't work in a market dominated by complex, hybrid, multi-strategy vehicles.
Yeah.
They are aligning the DIFC with modern international best practices by focusing on the actual risk profile of a fund rather than just, its marketing label.
And that structural shift really hits home when we look at the proposal to end the quote-unquote specialist class era for exempt funds in QIS.
Yeah, the qualified investor funds.
Right. Because for years, if you registered as a money market fund, you had one strict set of rules. A private equity fund had another. And now the DFSA is proposing to ditch those specialist classes entirely.
To give managers a flexibility to build those hybrid funds we were talking about.
Right. But I had to push back on this premise a little bit.
Okay.
If we remove these specific targeted requirements for money market funds and private equity and credit funds, aren't we just stripping away investor protections?
It does sound like that at first glance.
Yeah, it feels like we're deregulating under the guise of flexibility, basically creating a Wild West scenario for fund managers.
What's fascinating here is that this is absolutely not deregulation. It's really a strategic pivot to smart re-regulation.
Smart re-regulation.
Right. The DFSA isn't removing the safety nets. They're just changing how those nets are deployed. They're moving to a horizontal, disclosure-based model.
Horizontal, meaning applying to everyone.
Exactly. Under the old regime, crucial risk management rules were siloed. They only applied to specific types of funds. Now, those same risk management rules are being applied horizontally across all fund managers, regardless of what they call themselves.
So a rule targeting leverage or counterparty risk now blankets the entire ecosystem rather than just the funds that, self-identify as high risk.
That is the core mechanism, yeah. As a risk-based regulator, their primary concern is the actual exposure a fund creates, not the name on the term sheet.
Right.
If a hybrid multi-strategy fund takes on private equity-style risks, it needs private equity-style safeguards.
That makes total sense.
Yeah, and for example, the new framework mandates that all QIFs and exempt funds calculate their borrowing limitations in a reasonable and prudent manner.
Okay.
And because it's a disclosure-based model, they must explicitly report their expected maximum level of borrowing to their investors.
Got it.
Plus, they have to detail the exact methodology they use to determine that limit.
So the protection mechanism shifts from arbitrary caps to radical transparency.
Yes, exactly.
You're allowed to take the risk, but you have to show your math.
You have to show your work.
And we see this horizontal application affecting prime broker relationships too, right?
Big time.
Because previously, the stringent rules around prime brokers, specifically regarding like pooling assets, rehypothecation, using a fund's assets as collateral, those were overwhelmingly targeted at hedge funds.
Right, but counterparty risk does not care if your fund is labeled a hedge fund or a vanilla absolute return fund.
No, it really doesn't.
If you authorize your prime broker to rehypothecate your assets, you are exposing your investors to the risk of that broker defaulting, period.
Wow.
So the DFSA looked at that dynamic and realized that protections shouldn't be siloed. The new proposal expands those prime broker rules to cover all QIFs and exempt funds that engage in those specific activities.
So the underlying risk dictates the rule universally.
Exactly.
Tearing down the specialist labels while simultaneously raising the floor for risk management. I mean, that makes a lot of sense for the overall ecosystem.
It does.
But let's look at how this practically impacts the balance sheets of the managers running these niche strategies. Because the numbers in this consultation paper regarding credit funds are just staggering.
Oh, they're huge.
The base capital requirement just to operate a credit fund is plummeting from $140,000 down to just $40,000.
Yep.
Plus, the $10,000 application fee and the $10,000 annual fee are completely scrapped.
Gone.
It's basically a $100,000 discount on day one. So I have to ask, is the DFSA heavily subsidizing credit funds here? Are they trying to artificially stimulate, like, a shadow banking sector in Dubai?
Well, the optics definitely suggest a massive subsidy, but the arithmetic is actually tied to the removal of the specialist classes.
How so?
Under the old framework, to be officially classified as a credit fund, a manager had to allocate 90% of the fund's property specifically to providing credit.
Oh, wow, 90%.
Right. And that incredibly restrictive threshold triggered the punitive fees and higher capital requirements.
I see.
So since that strict 90% allocation rule is gone, maintaining the exorbitant fee structure would just be unjustifiable. The DFSA is simply normalizing the costs to match standard funds.
Okay, but even with the fees normalized, providing credit outside the traditional banking system is inherently risky.
Oh, without a doubt.
So making it cheaper to launch these funds seems like an invitation for massive systemic lending risks to enter the DIFC.
Well, the financial barrier to entry has indeed been lowered, but you have to look at the operational firewalls. They're just as thick.
Okay, that kind of firewalls.
If a fund's strategy involves providing credit, the manager is still bound by severe, non-negotiable limitations.
Like what?
They are strictly prohibited from making loans to natural persons. They cannot make loans for the purpose of trading.
Got it.
And there remains a total ban on providing credit facilities like letters of credit or financial guarantees.
Which makes total sense from a liquidity standpoint, because issuing a letter of credit is essentially writing a massive unfunded contingency check. If that letter gets called, the fund faces a sudden demand for cash. It likely doesn't have sitting idle. And that triggers a cascading liquidity crisis for the investors.
And the liquidity repercussions of shadow lending gone wrong can paralyze an entire financial hub.
Right.
So the DFSA's compromise here is highly pragmatic. They are giving managers the freedom to blend credit into wider multi-strategy portfolios without locking up 90% of their capital.
And they're lowering the cost of doing business.
Lowering the cost, but refusing to budge on the specific activities that pose systemic run-on-the-bank risks.
It is a calculated trade-off. And we're actually seeing a very similar thematic expansion in the venture capital space.
Oh, yeah. The VC framework?
Yeah, back in 2020, the DFSA rolled out a bespoke VC framework that stripped away some heavy regulatory burdens like the mandate for an internal audit function to basically accelerate startup growth.
Right, that was a big deal then.
And now, this consultation paper proposes expanding that framework to cover funds dedicated to investing in other venture capital funds.
Yep.
They're just throwing fuel on the fund-of-funds model.
Well, turbocharging the fund-of-funds ecosystem is a macroeconomic necessity for Dubai right now.
Why is that?
The region is aggressively transitioning toward a tech, AI, and Web3-driven economy.
Right.
And to scale a maturing startup ecosystem, you need massive pools of global institutional capital.
Makes sense.
Institutional allocators often prefer to deploy capital into a diversified fund of funds rather than taking single manager risk.
Right. They want the diversification.
Exactly. So by easing the regulatory friction on these specific vehicles, the DFSA is building a wider pipeline for global capital to flow directly into the local tech scene.
Speaking of pipelines, we need to look at how they are physically rebuilding the plumbing for master and feeder funds.
Oh, this part is fascinating.
This section of the paper almost reads like an admission of guilt regarding how unworkable the old rules were.
It really does.
Because for a public feeder fund to funnel investor capital into a master fund, the old regime required the master fund to have at least 3 market makers regularly offering its units for purchase or sale.
Which is just wild.
It's absurd when you think about it. These are private market vehicles. They aren't publicly traded equities on an exchange.
Yeah, that 3 market maker rule was a relic from 2010. It was initially designed to guarantee the master fund had sufficient liquidity to honor redemption requests from the feeder.
Right.
However, modern fund managers are already bound by comprehensive liquidity management regulations.
Like stress testing and all that.
Exactly. Stress testing, gated redemption protocols. The DFSA acknowledges in this paper that the market maker requirement was not just duplicative, it was entirely disconnected from the reality of how these institutional structures operate globally.
They're also scrapping the rule that restricted a feeder fund from holding more than 20% of a master fund's total units.
Another big change.
Which, I mean, if the entire architectural purpose of a feeder fund is to aggregate capital and pour it into the master fund, capping that allocation at 20% completely defeats the purpose.
The 20% cap was an archaic attempt to mitigate concentration risk at the master fund level.
Okay.
But when you evaluate it against the singular objective of a feeder structure, that cap is disproportionate. And really, it's just unnecessary.
Yeah.
More importantly, though, the DFSA is fundamentally expanding the legal definition of a master fund.
Oh, right. Because the legacy rules defined a master fund strictly as an entity that issues units to feeder funds.
Exactly. And that artificially locked out direct institutional investors who wanted to deploy capital directly into the master fund alongside the feeders.
Ah, I see.
So broadening this definition seamlessly aligns the DIFC with the master feeder structures used in places like New York and London.
Okay, so the fund structures are getting a massive upgrade. But what about the people actually pulling the levers?
The human element.
All right, we fixed the kitchen, but we need to talk about the chefs. Under the old regime, employees of a fund manager faced massive hurdles if they wanted to invest in their own private funds.
It really did.
Unless they personally met the astronomical minimum subscription amounts required for QIFs or exempt funds, they were totally locked out. The people generating the alpha couldn't even participate in the wealth creation.
And industry feedback on this specific friction point has been loud for years.
I can imagine.
Enabling employees to invest alongside their clients is the most effective mechanism for aligning incentives.
Having skin in the game.
Exactly. It's also a critical tool for firms trying to recruit and retain top-tier talent in what is a highly competitive global market. So the new proposal completely waives these minimum subscription amounts for employees.
But the paper notes this isn't just a blanket waiver for the entire company, right?
Right. No.
The IT department and the administrative staff don't get a free pass. It only applies to employees directly involved in executing investment decisions or providing direct investment advice.
Right. The chefs tasting their own soup.
Directly, or through specialized staff investment vehicles. But my immediate thought goes to the conflict of interest.
Sure.
If the portfolio manager has their own capital riding on a specific tranche, doesn't that incentivize front-running or, preferential liquidity terms?
The tension between aligned incentives and conflicts of interest is definitely the central challenge here.
Yeah.
To neutralize that risk, the DFSA is mandating aggressive disclosure protocols. Outside investors must be explicitly informed that fund manager employees have capital in the fund.
Okay, so transparency again.
Exactly. Furthermore, the manager must provide granular details on their internal frameworks for managing and mitigating any conflicts of interest that could arise from co-investment. Transparency remains the ultimate regulatory shield.
Now, while local employees are getting more access, the DFSA is completely dropping the axe on a very specific group of international managers.
Oh, you're talking about the EFM.
Yeah, the external fund manager regime. It's being killed off entirely.
This represents a major inflection point in Dubai's financial maturity.
How so?
Well, back in 2010, the DFSA introduced the EFM regime to allow foreign fund managers to establish and manage domestic funds in the DIFC without requiring a physical boots-on-the-ground presence.
Okay, kind of a remote option.
Right. It was designed as a low-friction entry point, a way for global managers to test the waters of the Dubai regulatory environment.
But if the goal is to attract global capital, why cut the cord on a program specifically designed to lower the barrier to entry?
Because the ecosystem has evolved past the need for it.
Really?
Yeah. When a manager operates outside the DIFC without a physical presence, the DFSA's supervisory reach and enforcement capabilities are structurally limited.
Oh, that makes sense. Hard to regulate someone who isn't there.
Exactly. And today, demand for full physical DIFC licenses is surging. The jurisdiction is now viewed as a premium global hub. The DFSA no longer needs to offer guest passes to entice managers. The global players are willingly establishing fully licensed local operations. The EFM regime has simply outlived its strategic utility.
It's the ultimate sign of a seller's market.
Yeah.
You don't hand out free samples when there's a line out the door to buy the product.
Exactly.
And we see that maturity reflected in a few very pragmatic operational tweaks, too. For instance, launching a new fund always involves friction. Capital calls get delayed, initial deployments take longer than expected. The old rules demanded a first annual report at 12 months.
Which is really fast for a new fund.
Super fast.
Yeah.
So the DFSA is extending that initial reporting window to 18 months, recognizing that a 12-month snapshot in a newly launched fund often provides a totally distorted view of its actual operational health.
It is a nuanced adjustment, but it drastically reduces the administrative burden on new entrants.
Yeah.
Alongside that, they're refining the legal definition of a fund manager.
Okay, what does that entail?
Historically, regulatory language focused on the concept of being legally accountable to the unitholders, or, the retail or institutional investors.
Right.
But modern fund architecture is incredibly complex. A manager's contractual obligation is frequently to the fund vehicle itself or an independent board of directors, rather than directly to the end investor.
So the DFSA is basically closing a potential loophole there.
Yes.
They're updating the language to ensure that even if a manager uses complex corporate structuring to route their accountability solely to a board, they still fall squarely under the regulatory umbrella as a fund manager.
Precisely.
And for anyone listening who operates a fund in this ecosystem, the timeline here is aggressive.
Very.
If these rules are finalized, the industry will have a transition period of just 3 months to adapt. And the deadline to submit comments on this consultation paper is September 7th, 2026.
The compliance teams will certainly be working overtime.
Okay.
However, once we look past the immediate structural renovations, Part 2 of the consultation paper pivots to a conversation about the fundamental architecture of future markets.
And here's where it gets really interesting.
It really does.
The DFSA included a dedicated items for discussion section focusing entirely on distributed ledger technology, DLT, and tokenization.
Yep.
Now, here is my major crypto conundrum. The DFSA was incredibly forward-thinking, right? They permitted tokenized fund units way back in 2021.
Ahead of the curve.
But, as they openly admit in this new paper, adoption has been practically non-existent.
Barely a blip.
There have been no material market developments. So why devote a chunk of a major 2026 regulatory overhaul to ask the industry for feedback on a dormant technology? I mean, is this just regulatory FOMO, a desperate attempt to look innovative?
If we connect this to the bigger picture, it is far more substantive than chasing blockchain hype.
Okay, I'm listening.
The DFSA is looking past the volatility of public crypto markets and zeroing in on the institutional plumbing of global finance. Right. Their specific focus here is on tokenized money market funds, or TMMFs.
MMF.
Yeah, we are not talking about retail speculation here. These TMMFs are emerging globally as highly efficient collateral instruments in massive, non-centrally cleared derivative transactions.
But if you are a massive institution posting collateral for a derivatives trade, why go through the headache of using a tokenized fund?
Good question.
Why not just post traditional cash or treasury bonds like they have done for decades?
The value proposition lies entirely in the ledger mechanics.
Okay.
A tokenized fund unit represents an immutable, instantly verifiable record of ownership, and crucially, it unlocks the capability for atomic settlement.
Atomic settlement.
Right. In legacy finance, transferring ownership of complex collateral can take days. It requires reconciliation across multiple siloed intermediaries.
I see.
But with a tokenized asset executing on a blockchain smart contract, the transfer of ownership and the settlement of the transaction occur simultaneously in a single, instantaneous operation. For institutions moving billions in collateral, eliminating settlement risk and operational lag translates to massive capital efficiency.
It's about upgrading the back office of global derivatives markets to operate at the speed of light.
Exactly.
And the DFSA is proactively asking the industry to identify which legacy rules are creating friction for this technology.
Precisely the goal. Current regulations heavily prescribe traditional paper-era methods for maintaining a register of unit holders.
Like actual physical ledgers.
Or just legacy digital databases. The DFSA is asking the market, do we need to draft new rules that explicitly authorize a fund to operate a fully digital register?
Where the blockchain itself is the register.
Yes, where the blockchain serves as the sole legally undisputed source of truth for ownership.
The level of operational depth they're exploring is wild because there is a specific detail in the paper about gas fees.
Ah, yes, the gas fees.
Yeah. If a traditional, heavily regulated fund decides to hold tokenized investments to capture that atomic settlement efficiency, they inevitably have to interact with a public or private blockchain.
Right.
And to process those transactions, they have to pay network gas fees, which are almost exclusively denominated in crypto tokens or stablecoins.
Right, like Ethereum or USDC.
Exactly. The DFSA is asking if funds need explicit regulatory carve-outs just to hold crypto tokens purely for the purpose of paying those blockchain utility costs.
Which highlights a fascinating regulatory bottleneck.
Yeah.
Are legacy rules, written for fax machines and SWIFT transfers, accidentally deterring institutions from adopting DLT just because they aren't technically allowed to hold the digital currency required to pay the transaction fees?
It's crazy to think about.
It is. The DFSA is actively crowdsourcing the friction points so they can systematically remove them.
It's an incredibly proactive stance.
Yeah.
So pulling back to view the entire landscape, Consultation Paper No. 173 represents a massive structural renovation of Dubai's asset management ecosystem.
A complete overhaul.
The DFSA is tearing up the fixed menus. They're empowering managers with hybrid flexibility, slashing capital requirements to foster a credit and venture capital boom, and laying the legal groundwork for blockchain-based institutional settlement.
That sums it up well.
Assuming these proposals cross the finish line after the September 7th deadline, the DIFC will become radically more agile. And, ironically, by abandoning those rigid specialist labels, they are arguably making the entire system safer through a unified, horizontal approach to risk management.
It is a very ambitious blueprint for scaling a global financial hub.
Definitely.
But before we conclude, there is one final thread buried in part 2 of the consultation paper that we haven't touched on yet.
Ooh.
And it presents a fascinating structural challenge I really want the listener to consider.
Lay it on us.
The DFSA is using this paper to solicit initial feedback on the concept of opening up long-term investment funds, or LTIFs, to everyday retail investors.
Everyday retail investors.
Yes.
Why is that such a monumental shift?
Because of the underlying assets. LTIFs are designed to provide financing to the real economy by investing in highly illiquid real assets.
Illiquid meaning hard to sell.
Exactly. We are talking about immovable commercial property or massive, decade-long energy transition infrastructure projects.
Oh, wow.
Historically, these funds are strictly gated for professional and institutional investors because the capital is locked up for years.
Okay, I see the immediate collision course here.
I thought you might.
Because the defining characteristic of retail investors, everyday people, is that they fundamentally demand the ability to pull their cash out.
Exactly.
If there's a personal emergency or if the macroeconomic environment spooks them, they want to liquidate their position immediately.
And that is the paradox to ponder. How can a regulator possibly design a safe, functional redemption mechanism for a retail investor who suddenly wants their money back on a Tuesday when that capital is physically locked up in concrete and steel in a 10-year solar farm project?
You can't.
Right, you cannot just slice off a fraction of a solar panel and sell it in an afternoon to meet a retail redemption request.
It's an incredible structural paradox. The regulator clearly wants to democratize finance. They want to give retail investors access to the high-yield, world-building assets that institutions have monopolized for decades.
Yes.
But they have to somehow square that noble goal with the unrelenting retail demand for daily liquidity.
It's a tough puzzle.
It's like inviting someone into that massive open-concept kitchen we talked about, letting them put a 10-hour slow roast in the oven, but they demand to eat it after 5 minutes.
That's a great way to put it.
How do you regulate the physics of that? That's a brilliant, unsolvable problem to leave our listeners chewing on.
Hopefully they come up with some good feedback for the DFSA.
So what does this all mean? It means the future of finance is being written right now. Thanks for diving deep with us.